Tulip Mania. If you walked through Amsterdam in 1636, you would have seen merchants, nobles, and even farmers trading not for gold or silver, but for tulips. These flowers, carried from the Ottoman Empire, had become trophies of wealth. The rarest, the striped Semper Augustus, looked like fire painted across white petals. Amsterdam merchant Adrian Pauw guarded his bulbs as if they were priceless jewels. On February 3, 1637, one bulb sold for 10,000 guilders, more than a canal house on the Herengracht. In today's money, that equals about $1.2 million. 2 days later in Haarlem, the auctioneer asked for bids. Nobody offered any money. The buyers avoided eye contact, pretending they were never interested in tulips at all. Promises were broken, and people who thought they were rich suddenly had nothing. The tulip bulbs were still there, sitting in baskets on the floor. South Sea Bubble. In 1711, the British government created the South Sea Company, promising investors unimaginable riches from trade in South America. Politicians like Robert Walpole and even members of the royal family backed it, and excitement spread through London's coffee houses. By 1720, speculation had reached fever pitch. Shares sold for £100 in January and rocketed to £1,000 by June. That's roughly £200,000 or $250,000 today for a single share. Ordinary people mortgaged homes to buy in, dreaming of fortunes. Then in September 1720, the truth began to surface. The company had almost no real trade at all. Panic followed, and prices collapsed. Investors were ruined, aristocrats disgraced, and London streets filled with angry crowds demanding answers. The shares were now worthless paper. Black Monday. On October 19, 1987, the New York Stock Exchange opened to panic. For weeks, markets had slid on fears of rising interest rates and trade deficits. The real spark was program trading. Pushed by firms like Morgan Stanley and Salomon Brothers, their computers dumped stock index futures when prices fell, unleashing a chain reaction. By midday, Chairman John Phelan of the NICE tried calming brokers, but the sell orders flooded faster than phones could handle. The Dow Jones Industrial Average collapsed 508 points, a 22.6% loss, wiping out over $1.4 trillion today. Overseas markets followed: London, Tokyo, Hong Kong. When the bell rang, exhausted traders slumped at their desks, waiting for someone, anyone, to explain what had just happened. Panic of 1873. On September 18, 1873, crowds gathered outside the offices of J. Cook and Company in New York. Cook, once called the financier of the Civil War, had poured more than $75 million into the Northern Pacific Railroad, a project with little revenue and endless costs. When his firm collapsed, panic spread instantly. The news exploded across Wall Street. Banks froze credit, depositors demanded gold, and the New York Stock Exchange shut its doors for 10 days. In the following years, more than 18,000 businesses failed. 100 railroads went under, and unemployment climbed above 14%. The boom ended not with celebration, but with boarded windows and silent factories. European sovereign debt crisis. In late 2009, the world learned that Greece had hidden billions in debt, and its deficit was actually 13% of GDP, more than 4 times the EU limit. Prime Minister George Papandreou admitted the truth, and markets panicked. Yields on Greek bonds soared, locking Athens out of borrowing. On May 2, 2010, Greece accepted a €110 billion bailout from the EU and EMF, the first of several. Fear spread to Portugal, Ireland, Spain, and Italy. German Chancellor Angela Merkel and ECB President Jean-Claude Trichet scrambled for rescue plans. Meanwhile, in Athens, protesters threw Molotovs at Parliament. Inside, politicians signed loan papers they doubted would ever be repaid. Russian financial crisis. On August 17, 1998, Russia shocked the world by devaluing the ruble and defaulting on 281 billion rubles of short-term debt, nearly $40 billion. Prime Minister Sergei Kiriyenko, only 5 months in office, admitted the treasury was empty. Low oil prices had gutted state revenues, tax collection had collapsed, and the war in Chechnya burned through what little remained. Banks locked their doors while desperate depositors begged for dollars. Within weeks, the ruble lost 2/3 of its value, wages went unpaid, and savings were wiped out. Foreign investors fled. Ordinary Russians turned to barter, swapping vodka for bread, while in Moscow, trading floors echoed with silence. Dot-com bubble. In the late 1990s, money poured into internet startups with no profits, but only promises. By March 10, 2000, the Nasdaq Composite hit 5,048 points, more than double its level 2 years earlier. Venture capitalists like Kleiner Perkins backed companies that added .com to their names, and Wall Street banks rushed IPOs. Then the money stopped. By October 2002, the Nasdaq had fallen 78%, erasing $5 trillion in market value. Giants like Pets.com vanished, while even Amazon lost 90% of its share price. Investors who thought they were buying the future were left staring at broken websites and worthless stock certificates. The internet remained, but their money did not. Japanese asset price bubble. By December 1989, Tokyo's Nikkei 225 peaked at 38,915 points, driven by soaring stock and land prices. The Bank of Japan under Governor Yasushi Miyano had kept interest rates low, fueling speculation. Land in Tokyo's Ginza district sold for over 30 million yen per square meter, and the grounds of the Imperial Palace were said to be worth more than all of California. But in 1990, the bank raised rates to 6% and the bubble burst. By 1992, the Nikkei had lost more than half its value, wiping out $2 trillion. Property prices collapsed, leaving banks with mountains of bad loans. Japan entered a lost decade where optimism disappeared, but the debt stayed behind. Asian financial crisis. On July 2, 1997, Thailand gave up defending the baht, which had been pegged to the US dollar. For years, banks had borrowed dollars cheaply and lent them at home for property and stock booms. But exports slowed, debts piled up, and speculators attacked the currency. The baht collapsed more than 20% in a day. Panic spread to Indonesia, South Korea, and Malaysia. By 1998, Indonesia's rupiah had lost 80% of its value, and GDP fell 13.7%. The IMF offered rescue packages worth over $110 billion, but demanded harsh spending cuts. Streets filled with protests, leaders fell, and entire families traded meals for rice, while bankers talked about stability. COVID-19 crash. In December 2019, pneumonia cases in Wuhan, China were traced to a seafood market. Within weeks, the virus spread worldwide. On March 11, 2020, the World Health Organization declared a pandemic. 2 days earlier, on March 9th, the Dow Jones Industrial Average fell 2,013 points, its worst day since 2008. On March 16th, it collapsed another 2,997 points, a record single-day drop, wiping out trillions in value. The Federal Reserve, led by Jerome Powell, cut rates to near zero and launched massive bond purchases. Congress passed a $2.2 trillion CARES Act bailout. Yet Wall Street's trading floors stayed empty, replaced by Zoom calls and eerie silence. The Great Depression. On October 24, 1929, called Black Thursday, Wall Street shook as stocks were dumped in a panic. For years, people had borrowed money to buy shares on margin, hoping prices would only rise. Big banks like JP Morgan & Co. tried to slow the collapse, but fear spread too quickly. On October 29th, Black Tuesday, the Dow Jones Industrial Average dropped 12%, wiping out billions in hours. By 1932, stocks had fallen nearly 90%. Banks failed and unemployment hit 25%. President Herbert Hoover told people recovery was near. Instead, bread lines stretched for blocks. Farms were lost, dust storms rolled in, and entire towns fell quiet, waiting for a miracle that never came. Global financial crisis. On September 15, 2008, Lehman Brothers filed bankruptcy after betting heavily on mortgage-backed securities tied to U.S. housing. For years, banks had sold subprime loans to families who couldn't afford them, then bundled the debts into complex products that rating agencies stamped as safe. When home prices fell, the whole system cracked. That day, the Dow Jones Industrial Average fell 504 points, and within weeks, trillions vanished worldwide. AIG and other giants needed bailouts. Treasury Secretary Henry Paulson and Fed Chair Ben Bernanke rushed through a $700 billion rescue plan. On Main Street, jobs vanished and homes were boarded up while bankers flew home in private jets, talking about lessons learned.